Okay, so hello and welcome to the module of the international tax optimization for individual. This is the first module, and in this module, basically, we are going to understand the basics of the international tax system. Okay, and we see also how to take advantages of those basic concepts, and of course, staying fully compliant with the law without breaking any law, without being absolutely legal. In this module, we'll cover also the fundamentals of the international law, but we also talk about the optimization of the taxes, and we are going to also discuss about the common misconception about this process. So let's get started straight away. Let's begin with the basics. Let's put it simply here. The international tax international taxation refers to the rules and the system that govern how taxes are applied in more than one country. Okay, when more than one country is involved. This, for example, can include earning income in one country while I'm residing to another country. Okay, classical cases, classical situation, I would say. And for example, if I also hold assets abroad, or if I simply travel extensively while I'm maintaining financial ties in multiple jurisdictions. Now, the international taxation is crucial because it determines first who can tax your income. So, is your country of residence that tax your income, or is the country where you earn the income that taxes your income, or both? And the second point is that what kind of taxes apply? As an income tax, so taxes on incomes, professional incomes, or taxes on capital gains, or taxes on inheritance tax, tax on inheritance income, etc., etc. So the point here is to understand better and familiarize ourselves with three key concepts: tax residency, double taxation, and tax treaties. Okay, so let's break down one by one. The first concept is the tax residence that determines which country has the primary right to tax you. Okay, every country has its own set of rules for defining the tax residency, but the most common one is the famous 183-day rule. So, which means that if you spend more than 183 days in a given country during a tax year, normally from January to December, 1st of January up to the 31st of December, but there are some exceptions all around the world, we're going to see which one, you're likely considered a tax resident in that country. However, residency isn't just about days spent in a country, because other factors must be taken into account, such as where you own your property, where your family lives, or where your economic interests lie. Those elements can play a big role. Let me give you an example. This is also a classical case of one of our clients here in ESENtaxa. We had spending 6 months in Bali, working remotely in Bali, but maintaining home and family in Germany. So Germany might still want some taxes from you. Well, still want taxes in general, huh? So because still considers you tax resident. So this is, for example, it's a classical cases that we have to take into account. Now let's move to the second key concept, which is the double taxation. The double taxation occurs when two countries claim the right to tax the same income. Okay, you have the same professional income. Two countries wants to tax you at the same time. For example, UK and US. Let's say you are an American freelancer who earns money from a client in UK. Both US and UK might want tax on the same income. And without a careful planning, you could end up paying taxes twice on the same type of income, on the same, in this case, professional income. Now, let's see now the concept 3, which are the tax treaties. The tax treaties, these agreements between countries are designed to prevent double taxation by determining which country gets the primary right to tax specific type of income. They also lay out methods to resolving for resolving disputes and provide tax credit or exemptions to ensure you are not taxed twice. Let me give you an example, just to clarify this thing. If you are under the US-UK tax treaty, so if you are saying, look, it exists a tax treaty between US and UK, I don't have to pay twice my taxes on the same professional income, as I was saying in the previous example. The income earned in UK, indeed, might qualify for a tax credit in US, and then you subtract taxes already paid in a country against the taxes that you're supposed to pay in another country, effectively reducing your overall tax liability. Okay, so these three concepts, tax residency, double taxation, and tax treaties, they form the foundation of the international tax system. Understanding them is the first step to optimize your taxes.